Have you ever pulled up a stock chart and just felt lost? You see all these squiggly lines going up and down, and it feels like you're trying to read a foreign language. Well, guess what? In the next few minutes, we're going to give you the keys to translate it all. We're going to break down exactly how to read these charts so you can finally understand the story they're telling. Let's get right into it. But before we get totally lost in the weeds with lines and patterns, let's start with a little wisdom from a legend, John Bogle, the founder of Vanguard. He's reminding us that, yeah, the tools are cool, but the big picture is all about common sense. Just keep that idea in the back of your head as we go. This is about making smart decisions, not necessarily about being the busiest trader on the block. All right, here's our game plan. First up, we'll talk about why we even look at these things, by understanding what a stock really is, a piece of the pie. Then we'll cover the two main ways people choose stocks. After that, the main event, decoding the chart itself. We'll also find the floor and ceiling for a stock's price. And finally, we'll wrap up by seeing how all this fits into an actual strategy. So let's start at square one. Why are we staring at these charts at all? I mean, what's the point? Well, it's because they represent something very real, and honestly, something pretty powerful for building wealth over time. See, a stock isn't just a ticker symbol zipping across a screen. When you buy a stock, you are buying a genuine piece of a business, a tiny sliver of ownership in that company, its brand, its products, its profits. You're a part owner, and that's exactly why its value and the chart that tracks it matters so much. And the stock market? Well, that's just the big marketplace that makes all of this possible. It's this incredible tool that lets regular people like you and me become owners in some of the most successful and innovative companies on the entire planet. Now, this number really gets to the heart of the why. Historically, if you look at the S&P 500, which is just a big basket of 500 of the largest companies in the US, it has returned about 10% a year on average. Now think about that. That's a whole lot better than what you'd get in a typical savings account, right? It really shows the long-term power of owning a piece of these great businesses. Okay, so if you want to get returns like that, you have to actually choose which companies to invest in. So how do investors do that? Well, it really boils down to two major schools of thought. And I like to think of it as the difference between reading a company's resume versus trying to read the mood in the room. On one side, you have fundamental analysis. This is like reading the resume. You're a detective, digging into the company's health, its profits, its debt, how good its management is. You're trying to figure out what the company is really worth. On the other side is technical analysis, which is our focus today. This is like reading the room. It ignores all the resume stuff and focuses completely on the chart, looking for patterns in price and trading volume, which is just the number of shares being traded. The core idea, the whole philosophy behind technical analysis is this. All that stuff from the resume, the good news, the bad news, the big announcements, it's already baked into the stock's price. They believe the chart tells you everything you need to know about what investors are thinking and feeling. All right, let's get to the fun part. Now that we know why we're looking at charts, let's learn how to actually read them. It's time to decode the anatomy of price. You've probably seen this one a million times. The line chart is as simple as it gets. It just connects the dots, showing the closing price from one day to the next. It's perfect for getting a quick, clean look at the big picture trend. Is the stock generally heading up, down, or just kind of going sideways? Okay, let's level up to the bar chart. This gives us way more info. Each one of these vertical bars tells the whole story. The very top of the bar, that's the highest price the stock hit that day. The bottom is the lowest price. And see those little horizontal lines? The little tick on the left is the price where the stock opened, and the tick on the right is where it closed. And now for the candlestick chart, which is a huge favorite among traders because it's so visual. It has the same info as the bar chart, but it's just easier to read at a glance. That thick part is called the body. If it's green, the stock closed higher than it opened, a good day for the buyers. If it's red, it closed lower, a win for the sellers. And those thin lines, the wicks, they show you the highs and lows. It's like a little picture of the battle between buyers and sellers for that day. So now that we can read the basic language of a chart, let's talk about two of the most critical ideas in technical analysis. Think of it like finding invisible floors and ceilings that often stop a stock's price in its tracks. First up is supports. This is basically a price floor. It's a level where a stock that's been falling tends to hit the brakes and bounce back up. Why does this happen? Well, it's because buyers see the price and think, hey, that's a bargain. They rush in and their demand overpowers the sellers, creating a floor. And here's a perfect example of what that looks like in the wild. See how the price drops down to this line, not just once, but multiple times, and it just struggles to go any lower? That's buyers stepping in every single time, defending that level. That line is the support. Now, the opposite of support is resistance. And if support is the floor, you can probably guess that resistance is the ceiling. As a stock's price is rising, it might hit a certain level where sellers think, okay, time to sell and lock in my profits. Their selling creates a wall that can stop the rally. Look at this chart right here. This stock price pushes up to this level over and over again, but it just can't seem to punch through. It hits that ceiling and falls back. That line marks the resistance. For traders, finding these floors and ceilings is huge because they can be key signals for when to buy or sell. Okay, so here's the million-dollar question. How does any of this fit into a real strategy? The truth is, how much you care about these short-term patterns on a chart depends completely on your timeline. Are you in this for a day or for decades? This table lays it out perfectly. You've got your day trader, who lives and breathes these charts, making tons of trades all within a single day. Then you have a swing trader, who might hold on for a few days or weeks, trying to catch a short-term trend. And finally, there's the position trader, who holds for months or even years, acting much more like a traditional investor. So let's put it all together. Those day and swing traders, they are all in on technical analysis, constantly reading the room. A position trader might look at a chart to find a good time to buy, but they're still mostly focused on that company's resume, the fundamentals. And you know what? For long-term passive investors, the little day-to-day wiggles on a chart are basically just noise. And this brings us right back to where we started, with that John Bogle quote. Because as fun and exciting as chart reading can be, it is a tool, not a crystal ball. Study after study shows that for most people, trying to jump in and out of the market usually ends up performing worse than a simple strategy of just buying good investments and holding on for the long haul. So there you have it. We've demystified those squiggly lines. You can now look at a chart and read the story of the battle between buyers and sellers, of those invisible floors and ceilings. But the biggest question isn't just about what the chart will do next. It's about how this new skill fits into your own financial journey. So what's your strategy going to be?